Commercial real estate has just taken a turn for the worse. And I know what you're thinking. It's already bad, and it is. It's very, very bad. But guys, some of the shining stars like industrial, multifamily are now collapsing. Now we have a third wave of problems hitting commercial real estate. The vacancy and pressure on income has been one problem that first hit office and now is spreading to multifamily. Then we had the refinance wave that's becoming a problem with every single month getting worse and worse. The inability to refinance, really not due to income, but due to expansion of cap rate and higher interest rates requiring owners to actually write huge checks to be able to refinance. Well, now a third wave of problems, which was highlighted by WeWork. Now, it's not just WeWork. This is much, much bigger and much more problematic. We're going to get into it. So let's take a look at this report by Green Street that highlights just exactly what I'm saying. Industrial down 9.3% in the past month. Apartments down 8.6% in the past month. These are huge moves down, but industrial, up until this point, Trepp was reporting that industrial was almost non-existent with their delinquencies, now up 226 basis points, which is a huge move in 1 month. Well, what is happening? CNBC is highlighting that the global freight recession has begun and it will continue into 2024. Now, found this feed by Greg Fuller that talks about the freight market experiencing a severe recession and even calling it a bloodbath. Check out some of these headlines. Yellow files for bankruptcy. We've heard that one. Convoy, a $3.8 billion valued VC-backed freight brokerage, completely shut down. Guys, they tried to sell this and couldn't. And this is a company that was backed by Jeff Bezos. So this is a huge deal. Nearly $500 million in debt catches Western Global bankruptcy. Slink winding down operations as it looks to try to avoid bankruptcy. North Carolina Trucking Company shut down. Fraud, theft, and abuse forced Texas freight brokerage to shut down. Listen to this one. 95-year-old family-owned California trucking company ceases operations. 40-year-old Montana Trucking Company shutters. Michigan-based Sunset Logistics abruptly ceases operations. And you can see the headlines go on and on and on and on. It is just complete mayhem in the freight industry. And if you don't think it has implications for the industrial, I mean, again, just look at what happened in the past month with industrial. And guys, this has been the strongest asset class, avoided delinquency rates up until October, but now we are starting to see it fold. Now, this comes on the heels of delinquent commercial real estate being the highest that it's been in 10 years. And you can see we're almost at $20 billion in delinquent debt. And look at some of these price drops that Green Street is calling out. San Francisco's down 60%. Office values are down 60% in San Francisco. Los Angeles and New York down almost 55%. Seattle over 50%, Miami 46%, Chicago over 40%. These are massive moves down, guys. It's hard to overstate just how massive. I mean, we're talking about hundreds of billions of dollars that are just getting wiped off of balance sheets right now. And here, this is before WeWork filed bankruptcy. They are rejecting leases that leave $2.5 billion in CMBS exposed. So here we've got more exposure to commercial mortgage-backed securities. And guys, these aren't delinquencies in the sense of from vacancy. These are delinquencies that could happen because of a corporate bankruptcy. And just to give you an idea, there's 40 million square feet that WeWork occupies globally, 40 million square feet of occupied office space. Because WeWork is just one business. And the Financial Times is calling out that default rates could skyrocket among corporate debt. Corporations could start going bankrupt a lot more than they are now. And they've already started, bankruptcies have already skyrocketed to the highest they've been since the pandemic started. Now, this is the third wave of problems with commercial real estate. Because if bankruptcies happen, think about this, guys. We're not talking about leases that are expiring and people just don't renew. We're not talking about refinance troubles because cap rates expanded, so you have to write a check just to get a maturing debt, a loan on a maturing debt. We're talking about bankruptcy of leases that had 5, 10 years out before they expired. These are leases that not only aren't being renewed, but they're getting canceled in the middle of their term. This kind of risk, when it comes to corporations across the board, obviously WeWork is highlighting this because of how much office they occupied. But there are bankruptcies much smaller than WeWork that are happening all the time. And there are bankruptcies like Carvana that haven't happened yet. But guys, Carvana is a zombie company. They can't even pay their interest. They worked out a deal where they would just capitalize their interest, which is just a fancy way of saying, hey, we're not going to pay our interest, but we'll put it as a liability on our balance sheet and we'll owe it to you later when we become profitable. That's how bad Carvana is right now. And they have 2.4 million of occupied commercial real estate. 1 million of that is office space, but 1.4 million of that is retail and industrial. So think about it. These are companies that you've heard of. What about the companies that you haven't heard of that are going bankrupt? Think about this, guys. Look at this WeWork property, 901 Woodland Street. Now, this was almost exclusively a WeWork. There was like a very small percentage that wasn't WeWork. It's pretty much a WeWork building here in Nashville. Now, they're either rejecting the lease or they are going to renegotiate their leases. And this property has a $9 million loan on it from Wilson Bank and Trust, which is a regional commercial lender here in Nashville area. Now, if this is a one-off, not a big deal. But what happens when these commercial properties start falling like dominoes and these mortgages, like this $9 million mortgage, I mean, are they going to be able to pay? Do they recover some of what they owe? Do they recover, how much do they recover in terms of payments? And where do they stand? And are these write-offs going to sink the regional banks? The truth is that nobody knows. Nobody knows how big this is going to be. I don't know how big it's going to be. Nobody knows. Even as the ABA tries to quell their fears and say, oh, CRE fears are overstated for things like average loan to value ratios are lower than they were pre-Great Financial Crisis. Well, the problem with this kind of thinking is Signature Bank has $33 billion of commercial property loans that are expected to attract bids as much as 40% below face value, guys. 40% below face value. That means that their low loan to value ratio wasn't enough to prevent them from having a 40% loss on the value of these bonds and loans that they have as assets on their books that are now being liquidated. So this is a massive change in commercial real estate, and it will only, unfortunately, get worse from here. I don't know how bad it's going to get because, like I said, these headlines are no longer national headlines. Most of these headlines aren't even hitting mainstream news anymore. Like this, the mall at Tuttle Crossing, it was liquidated with an 87% loss, according to Fitch Ratings that published this month. I mean, this is absolutely massive. Now look at this Cato report, because I want you to realize that if you don't own commercial real estate, these things are going to impact you in ways that there are unintended consequences of this that we haven't even fully realized yet. Like this right here, the implications of the commercial real estate collapse on local government revenue. Let me just highlight one quote from this. Overall, San Francisco's commercial property valuation decline places at risk about $700 million in annual revenue, or about 11% of total general fund collections. Okay, so listen, guys. San Francisco's obviously been the worst hit by this so far, especially in the office space. But they are putting at risk 11% of their total general fund. Now, I don't know exactly how San Francisco is going to handle this. But what I do know is that if this happens in Tennessee, which it is going to happen and is happening right now, that as commercial properties decline in value, that they reset property tax rates so that the revenue doesn't drop. Now, what that means is in a market where revenue is, or where property values are increasing, your property tax rate is dropping all the time because they don't raise it, they don't lower it, they just reset the property tax rate. Now, what happens when one specific segment within a city drastically drops in value, like what's happening in commercial, is they're going to reset the property tax rate so that it's revenue neutral to that city. Well, take a city like Nashville, urban area, and if the property values get decimated, then they're going to reset the property tax rate so that it's revenue neutral. Who's going to pick that up? It's going to be residential and the other commercial buildings that are able to pay their bills. And it's going to be a tax increase, even if there's no vote on tax increase. So just keep in mind, this is just one example of how this is going to play out. And who knows? I don't know all the other ways it's going to play out. Just keep in mind, this is going to be wild. Now, if you want to stay on top of this, as I'm tracking, I'm learning about this. I'm trying to track. So this is just me publishing what I'm learning and trying to get more involved in commercial real estate. And if you want to stay on top of it, click subscribe and even click that notify button. And as soon as I learn about these things, I will publish them and let you know so that you can stay on top of what's happening specifically in the commercial real estate space. Hope this was helpful, and I look forward to seeing you next time.